Good evening. This is outreach program for revised guidance note on tax audit under section 44AB of Income Tax Act. As you are aware that now tax audit for the assessment year 2022-23 have commenced, and soon they will be accomplished and the tax audit reports shall be uploaded on Income Tax website. It is necessary that the Direct Tax Committee provides guidance in the matter of conduct of direct tax audit. This tax audit has commenced from the year 1984, and Institute has published guidance note as to how to conduct this tax audit and what are the nuances for reporting, for doing audit. Since 1984 till today, there have been substantial changes in the format of tax audit report, the particulars that are solicited from the tax auditor. The last revision of tax audit report has been in the year 2014. Thereafter also significant changes have taken place, but technical guides have been published and guidance is provided. However, there was demand of the profession that for the tax audit, rather than referring to 3-4 publications, it would be better that if one publication is available. So the Direct Tax Committee has decided to revise the Tax Audit Guidance Note 2014 and release this Tax Audit Guidance Note. The draft has been released, and there are certain significant changes in this particular Tax Audit Guidance Note. So let us take note of those changes, and then we will go to the issues that are to be raised by the audience. The first difference is, earlier tax audit guidance notes were just titled Tax Audit Guidance Note under section 44AB of Income Tax Act 1961. Now, for the purpose of this guidance note, there would be a suffix assessment year 2022-23. Thus, this guidance note will provide guide for conduct of audit for the assessment year 2022-23. The law which is relevant for this assessment year is solely discussed. What is the history of a particular section? So if you read earlier guidance note, it stated that, okay, this particular section was introduced in the year 2007, then it got amended in 2013, then it was further amended, omitted, etc. So for a reader, he had to capture what is the law which is applicable for the relevant assessment year. In order to dispense with this particular exercise by the person conducting tax audit or the stakeholders addressing the tax audit, it has been decided that only relevant provisions of law which are applicable for this assessment year will be discussed, which would be applicable for a subsequent assessment years or former assessment years are not discussed. So any chartered accountant conducting audit, if he has this particular guidance note in his hand, he would be able to conduct the audit, seek the guidance. Also, the staff members who are deputed to conduct tax audit under section 44AB, if they are having this particular guidance note, they will also find ease in conduct of audit. This is the first change which we aim to bring about. Secondly, the difference between the tax audit report available in the rules and in the schema. When we noticed that the tax audit report has been published in the income tax rules, which is having authority of rule 6G and section 44AB. So this is one piece of form which is available. Secondly, the tax audit report in particularly form 3CD is also available on income tax website in the schema for the purpose of uploading the tax audit report. There are certain changes. These are minor changes, but certain minor changes have got major significance. Say for example, in case of the clause relating to mod VAT credits, NVAT credit, etc. or service tax, they make mention of central excise, service tax or tax under Finance Act, etc. There is no mention of GST is made in these clauses. There is no amendment to these clauses in the rules. However, schema also makes mention of GST. It also mentions input tax credit. Now, when this aspect was deliberated in Direct Tax Committee meeting, it was realized that ultimately, if you consider the law is provided in the Income Tax Act 1961, Income Tax Rules 1962. So, the form which is released under the Act, Section 44AB or the Rule 6G, is the Form 44AD, which is available, Form 3CD, which is available in the rules. So we shall follow the form available in the rules, which is having sanction of law. One which is in schema is not having sanction of law. It is a facility made available by the Central Board of Direct Taxes. So we shall not refer to those schema, and therefore in respect of the words which are available in schema, we feel that even if the reporting is not made, there will not be non-compliance with provisions of Section 44AB or Rule 6G of the Act and rules. So we have confined the guidance to the rules. This particular fact we have also communicated to the Central Board of Direct Taxes, hoping to receive their views. Then coming to two clauses which were introduced in 2018, Clause 30C and Clause 44. 30C is about impermissible avoidance agreement or transaction, and 44 is about particulars of GST. There were representations from various stakeholders since inception of these clauses in 2018 that there are certain difficulties and these should be omitted. In 2018, the reporting was kept in abeyance by the circular issued in 2018, which stated that the tax audit reports issued from 28th August 2018 to 31st March 2019, these two clauses are kept in abeyance. And this process of keeping the two clauses in abeyance has been continued by three subsequent circulars issued in 2019, 2020 and 2021. The last circular keeping these clauses in abeyance till 31st March 2022. The question arises whether this 2022 means financial year ended 31st March 2022 or the reports issued till that date. And considering these four circulars together, a view was formed by the committee that it is reporting till 31st March 2022 and these clauses are applicable for tax audit reports to be issued for the assessment year 22-23. However, for the similar reasons which difficulties were communicated to the Central Board of Direct Taxes, again the Direct Tax Committee has made representation that there is a good case for omission of these two clauses. Coming to clause 44, it requires analysis of expenditure based on GST registration. Say for example, where the expenditure incurred results into payment to composition dealers, payment to registered dealers, unregistered dealers, etc. So in this case, the committee formed a view that in case of income tax, for the purpose of ascertainment of taxable income, whether particular expenditure is incurred which results into payment to whether registered dealer, unregistered dealer, composition dealer, has no bearing on tax computation. If you consider the objective of tax audit report, it is subservient for the purpose of income tax officer to ascertain taxable income, and this particular information is not having any bearing on assessment of taxable income. Therefore, it should be omitted. If at all these analyses are useful for GST, then the questions may be appropriate, but the place of having those questions is incorrect. It should be in GST annual return and not in tax audit report. And thirdly, the data available predominantly can be compiled by the assessee in annual return. The due date for annual return is post furnishing the due date for the purpose of furnishing tax audit report. So therefore, data also will not be readily available. And thirdly, there may be various assessees who are not liable to GST or who are covered under reverse charge. They may not be having this data, say for example, advocates, doctors, etc. or transporters. So this particular reporting should not be made mandatory. And as far as clause 30C, impermissible avoidance transactions is concerned, all other clauses of Form 3CD solicit particulars. Here the opinion is solicited. 3CD is meant to confirm the particulars. The decision or the view is to be taken by the assessing officer. So seeking opinion from the chartered accountant or the auditor is out of the place. Therefore, this clause should be omitted. Secondly, as far as this Form 3CD is concerned, in Form 3CB and 3CA, the auditor certifies all the particulars in Form 3CD to be true and correct. Against clause 3C, particulars are not there. It is the opinion that particular transactions which are impermissible, these are reported. And opinion cannot be correct or incorrect. It can be acceptable, not acceptable, good, it can be excellent, whatever. But to certify opinion as correct is unheard of. Therefore, it should be omitted. And thirdly, even the income tax procedure, if you look at in the Income Tax Act, the law also does not consider assessing officer to be competent to react to this particular issue. He has to escalate his apprehension to the Commissioner of Income Tax. The Commissioner of Income Tax in turn has to refer it to the panel of commissioners. They are seized of various information, the transactions, etc. And based on that, they will take the view. So the view is to be taken by very highest authority of the Income Tax Department, and that too a group of such commissioners and not individually. So casting such onerous responsibility on the shoulders of individual chartered accountant is also not appropriate. Let us see whether these representations are accepted, because we have called for omission, and if the deliberations have not taken place because the representations are made since 2018, at least for the financial assessment year 2022-23, these two clauses should be kept in abeyance. That is our representation. The representation may be accepted or it may be rejected. If accepted, there is no reason to report. If not accepted, in guidance note, it is perceived that we may offer certain standard wordings in which the tax auditor can report so that he will not incur significant responsibility. And that is also demand of the profession by and large. So in this background, the draft guidance note has been placed for your consideration. Any guidance note which is issued by the institute is placed for consideration of the professionals, the chartered accountants, other stakeholders, the Income Tax Department in this case, and the chambers of commerce, etc. So duly it has been circulated. And today we are holding this outreach program, which is open for all the members of the institute. So we seek inputs for improvement of this guidance note from the members. So with this preamble, now let us turn to the issues which are raised from the members. Certain issues are received in office. So I would request, let us deliberate on those issues. Then we will come to the audience. If they want to raise the issues, they can put them in chat box and we will respond to that.
Sir, many members are raising only one type of query, that whether this clause 44 is applicable from the assessment year 22-23 or not, sir. There are a number of queries regarding only this clause, sir.
Yes, there is discussion also going on. There are two views in this case. One set of views says that circular issued in 2021 states that clause 30C and clause 44 is kept in abeyance till 31st March 2022. And one set of professionals believe that this 31st March 2022 means it is not applicable or kept in abeyance for the financial year ended 31st March 2022. The other view is that the reports issued till 31st March 2022, there need not be furnishing of information on clause 30C and clause 44. Now, if you look at history of circulars, this is not the first circular. The first circular was issued in the year 2018, and the circular acknowledges that various representations have been received informing difficulties in reporting under clause 30C and 44, and considering these difficulties, the reporting under clause 30C and 44 of Form 3CD has been kept in abeyance for the reports issued from 20th August 2018 to 31st January 2019. Thereafter, circular issued in March 2019 said that considering the representations and difficulties faced, this particular fact of keeping the two clauses in abeyance is extended till 31st March 2020. Circular issued in 2020 says that considering the advent of pandemic, these two clauses are kept in abeyance till 2021, 31st March. Circular issued in 2021 states that considering the situation of pandemic, reporting on these two clauses 30C and 44 is kept in abeyance till 31st March 2022. So if you read all the four circulars together, it means whatever date is given, the date is relating to issuing of tax audit report and not the underlying financial year. Therefore, a view taken at the DTC is when it is stated that it is kept in abeyance till 31st March 2022, it means the reports issued till 31st March 2022 and not thereafter. So now for the assessment year 2022-23, the reports will be issued on or after 1st April 2022. The date is post 31st March 2022, and therefore the benefit of this circular stating that the reporting is kept in abeyance is not available for the assessment year 22-23.
Thank you, sir.
Thank you very much, sir, for enlightening us. There is one more question which has been raised by a member that there it appears that there are some changes in the tax audit report, sir. Can you please elaborate in case if there are any views on this, sir?
As far as this year is concerned, there are no changes in tax audit report. Whatever was there, it is there. The changes are principally relating to depreciation, where the law has been amended and there is no allowance of depreciation on goodwill. So relevant information has been solicited. Also, in respect of certain class of companies and assessees, a concessional tax treatment is made available under section 115 BBA, etc. And wherever the assessee is opting for this concessional tax treatment, they are not eligible to certain allowances like additional depreciation, deduction under chapter 6A, etc. And in this case, whatever losses that are carried forward, whatever additional depreciation which is unabsorbed, that lapses, and the information relating to this lapsed portion of depreciation or unabsorbed losses, unabsorbed depreciation or carried forward losses is also solicited. Besides this, all other questions were earlier also there. And another change is about this clause 30C and 44, which were kept in abeyance, are now applicable. And you know, there are three sections which are anti-avoidance sections, section 269SS, 269ST and 269T, relating to borrowing, loans, advances, specified transactions in immovable property, certain other transactions with turnover exceeding a particular limit, or repayment of loans and advances. So these are bifurcated into various sets of questions, and those questions are being asked. So otherwise, there are no significant changes in the tax audit report for the year 2022-23 as compared to the earlier assessment year.
So next question is for section 44 ADA. Under section 44 ADA, eligible assessee if not up to offer profit of 50% of gross receipts, then he is required to get accounts audited under section 44 AD. Profession under section 44 double A includes technical consultancy, where technical consultancy is defined in Income Tax Act, or what is covered in this?
As far as technical consultancy is concerned, it is defined in Section 9 of the Income Tax Act with reference to income which is earned from by non-residents from countries abroad. In what circumstances such income is deemed to accrue or arise in India. So there, even legal and technical consultancy fees or engineering is received. So Section 9, one will find definition of technical consultancy, and that is the meaning of technical consultancy. We'll just check what is stated in Section 9. If you refer to clause 7 of Section 9, subsection 1, explanation 2 defines technical consultancy. It says that for the purpose of this clause, fees for technical services means consideration, including lump sum consideration for rendering any managerial, technical or consultancy services, including provision of services of technical or other personnel, but does not include consideration for any construction, assembly, mining, or like project undertaken in the receipt. So from this one can understand what is the meaning of technical, because otherwise technical service is not defined.
So next question is for the applicability of tax audit under section 44AE. In this case, he referred a case and assessee engaged in the future trading of shares and have turnover of rupees 60 lakhs in the financial year 21-22, and he incurred losses. Rather than notional 8% profit, now he is asking, though his turnover is less than 1 crore rupees, whether he is required for the tax audit under section 44AE.
Now, if you refer to applicability of tax audit under section 44AB, it is prescribed that if your turnover exceeds 1 crore rupees, then tax audit is applicable. However, section 44AD provides that wherever you are engaged in any eligible business and your turnover is below 2 crore rupees, you have to minimum report 8% of turnover as income. If the turnover is through banking channels, then 6% of turnover as income. If you are reporting income below this 8% or 6% as is applicable, in that case you shall maintain books of account and you shall get your accounts audited. To that there is an exception, that income of a person should exceed the maximum limit not liable to tax. So in this case, if we consider that the concerned person is an individual and he is not having any other income, then his income which is loss is below the threshold limit of 2,50,000, and as such he is not required to conduct the tax audit or get the accounts subjected to tax audit. Secondly, in case of partnership firm or company, the threshold limit is 0. However, after considering set off of this particular loss, if still there is a loss, then there is no requirement of tax audit. But if there is any positive income, then it is liable to tax and there may be requirement of tax audit. Even in case of individual, supposing if he is a salaried person and having income exceeding 2,50,000, in that case, even to claim this loss, his accounts will have to be subject to audit. So in this way, one has to consider the applicability of audit. Incidentally, when we say that the turnover is 60 lakh, it will be appreciated that this particular turnover, if there are losses and if there are profits, both ignoring the signage minus or plus, you have to add profits and losses and then consider what is the total, and that is the turnover.
Thanks a lot, sir. Related to this only, there is one more question raised by a member regarding the applicability of the provisions who deal in retail business in cash and not maintaining books of accounts due to practical reasons, sir. Kindly advise, sir.
No, you just repeat, who deals in?
Who deals in retail business in cash and not maintaining books of account due to practical reasons, sir.
I appreciate for practical reasons there are many things which we cannot do. However, wherever law obliges that you have to maintain books of account, you cannot say that it is not possible. And in case of law, if your income exceeds 2,50,000 or turnover exceeds 25 lakh rupees, under section 44 AA, it is necessary that you should maintain books of account. So if he fits into the criteria mentioned by the Income Tax Act or the rules for maintenance of books of account, it is obligatory for him to maintain the books of account. Now, in case of any person who is engaged in trading, there are provisions in section 44 AD that if his turnover is up to 2 crore rupees, maybe he is spared from maintaining books of account if the minimum estimated income is reported, and that minimum estimated income is 8% of turnover or 6% of turnover, that is sales which is through banking channels. In those two circumstances, supposing his turnover is 1 crore rupees and he is offering say income of 8 lakh rupees or 10 lakh rupees, in that case it is not necessary for him to maintain books of account. But then again the question remains that how he will justify that his turnover was 1 crore or 90 lakhs. So at least books of account enabling him to justify his turnover are required to be mentioned, required to be maintained. And also one incidental aspect one has to remember is we are talking only in terms of provisions of Income Tax Act. But there are other laws also like Goods and Services Tax, where the turnover may be subjected to GST liability. He may be eligible for certain set off. And in case of GST, he is not spared from maintaining books of account. So all the acts have to be considered. As far as income tax is concerned, fine, if he is able to justify the turnover, he need not maintain books of account. But if his turnover exceeds 2 crore rupees, then or 25 lakh rupees, exceeding 25 lakh rupees, it is necessary he has to maintain books of account unless he reports turnover under estimated income scheme. And if the turnover exceeds 2 crore rupees or 1 crore rupees, he is liable for tax audit. So in that case, again maintaining books of account is necessary.
Thank you very much, sir. One member has raised a question that for the purpose of 4480, 8% profit is to be considered whether before interest and remuneration to partners or afterwards, sir.
This is question concerning a partnership firm. As we are aware that partnership firm, if it pays remuneration to the partner or interest to the on capital of partner, then it qualifies for deduction, and there is limit to those deduction and procedure is laid down in section clause B of section 40. So if the partnership firm is maintaining books of account having income of say 5 crore rupees and paying a remuneration of 1 crore rupees to the partner, 50 lakh rupees interest to the partners, that qualifies for deduction. When we talk of estimated income scheme, we are not considering any deduction for the purpose of ascertainment of income. Here, whatever 8% or 6%, supposing the turnover is 1 crore rupees and the assessee is offering 8 lakh rupees as income, and this 8 lakh rupees is considered after granting deduction for the purpose of remuneration or interest. So separate deduction from rupees, this estimated minimum amount of income is not available. And secondly, if even in case of estimated income scheme, if the partnership firm pays tax on 8 lakh rupees and it has already paid say 8 lakh rupees remuneration to the partners, those partners will have to again pay tax on 8 lakh rupees remuneration received. Whatever share of profit they receive is exempt from tax under section 10(2)(a), but whatever remuneration or interest a partner receives, whether the firm is offering income from estimated income scheme or otherwise, it is liable to tax and in the hands of partners.
Thank you, sir. Now the main question is for applicability of this tax audit. So whether tax audit is applicable based on receipt if it crosses more than the limit specified under tax audit clause. Though the turnover sales is less than such limit, what is the significance of receipts as per law?
The words used are turnover or sales turnover or gross receipts. Now, as we are aware that whenever any person is engaged in business for the purpose of ascertaining his income, books of account are required to be maintained. For maintenance of books of account and ascertainment of profit for the purpose of income tax, Section 145 deals with the method of accounting. There are two recognized methods of accounting: accrual basis or cash basis. In case of accrual basis is followed, whether you receive the money or not, if the sales or the income has accrued, arisen till the year end, it is required to be recognized. But in cash basis, if you actually receive the income, then only it is recognized. So this word receipt is used qua those assessors who are maintaining books of account on cash method of accounting. When they receive cash, they consider it as income. When they pay cash, they consider it as expenditure. So if the books of account are maintained on accrual basis, whether you receive the amount or you do not receive, the income accrued or the sales which have taken place till 31st of March will have to be considered for the purpose of this amount of turnover and the limit. If you are maintaining accounts on cash basis, then the receipt or the actual receipt of money will have to be considered. Of course, in actual receipt of money, even in barter you have received something in kind. Supposing you are selling some goods or etc. and you receive this particular income by way of certain amount of gold, then even that gold will be, receipt of gold will be considered as receipt of cash, and accordingly it will have to be accounted for.
Thank you, sir. He's saying a person earns on salary income and also side by side he deals in buying and selling of shares. Then still it is compulsory to maintain books of accounts.
See, in case of books of account, the law does not consider what is the main occupation of the person, what is the side by side activity. Income from business is computed as per provisions laid down in law. There is one provision, section 44AA in the Income Tax Act. Section 44AA requires maintenance of account by any person who is engaged in business, whether that business may be a regular business or it may be adventure in the nature of trade or it may be part-time business. It does not make distinction between the manner in which you are conducting business. If you are conducting business, you are required to maintain books of account. If your turnover exceeds 25 lakh rupees or your income exceeds 2,50,000 rupees. So coming to the question, even if he is an employee, side by side he is doing share trading, so he is in business, so his turnover in business exceeds this threshold, it is necessary for him to maintain the books of account. Not only that, if that turnover breaches the threshold for the purpose of tax audit, he will have to also subject his accounts to tax audit.
Now, similarly, he is again asking if individual has become NRI and he was outside India for more than 182 days during financial year 21-22, has dealt in future and options, having turnover 50 lakhs and having taxable income exceeding the tax audit applicable to him for carry forward of losses. So, whether the tax audit is applicable in this circumstances?
No, actually the question is not clear because the tax audit is not contingent upon the carry forward of losses. whether a person is resident or non-resident, if he is indulged in business activities in India or the income from which is taxable in India, in that case where the turnover exceeds 1 crore rupees, it is necessary for him to conduct the tax audit. If turnover is up to 2 crore rupees and he is reporting income which is below the minimum required income under section 44 AD or ADA, as the case may be, whether he is in business or profession, then in that case tax audit is required to be conducted.
Whether the assessee is required to support expenses after declaring 8% or 6%?
This is estimated income scheme. So after declaring income up to statutory minimum or more than that, it is not necessary that expenses are required to be supported, because if you read the provisions of section 44 AD, it says that notwithstanding anything contained in section 28 to 44, so whatever deductions we talk of are from section 30, 31 to this 44 section. So whatever may be stated in those sections, that is not considered. Assuming that he has incurred cash expenses of 50,000 rupees, which is not permissible, so there may be certain disallowance. But irrespective of these allowances or disallowances, the law estimates the minimum income at 8% normally. If the transactions are through banking channels, minimum 6%. So one can report income of minimum 6% or 8% as the case may be, or more than that. And in that case, the tax audit is not applicable.
Next question is, sir, in case of private limited company having nature of business software development services, company have no cash expense or income, whether limit of 10 crore applicable for software development services is applied or profession to be considered, and above 50 lakh tax audit applicable, sir?
As far as profession is concerned, generally the professionals are abide by certain rules, etc. In case of company, if the company is engaged in software development, it will be treated as business of a company. And if the turnover is up to 10 crore and it is not only income, it is all receipts as well as payments do not exceed 5% otherwise than through banking channels. So it is possible that the turnover is 5 crore rupees, which is entirely through banking channels. However, if they have any other receipt, maybe introduction of capital or any other thing, and that cash receipt plus sales taken together, the non-banking receipt should be contained within the limit of 5%. Then tax audit will not be applicable.
Thank you, sir. Sir, members are requesting, sir, can you please again repeat the applicability of clause 30C and 44, sir, because they missed some portions, sir. So that's why they are requesting, sir.
Okay, we are many people are habitual of appearing for exam in the month of November after appearing for May. Friends, as far as these two clauses are concerned, clause 30C and clause 44, whether these are applicable for the assessment year 22-23, for which now audits are going on, is the issue. As you will appreciate, these clauses have been introduced in the year 2018. In the year 2018, various representations were made, and then the Central Board of Direct Taxes has issued a circular stating that considering various representation and appreciating difficulties, the reporting under clause 30C and clause 44 is kept in abeyance for the reports issued between 28th August 2018 to 31st March 2019. In 2019 March, one more circular was issued stating that considering the representation made and the difficulties faced by the stakeholders, these clauses have been kept in abeyance till 31st March 2020. In 2020, a circular was issued stating that considering the situation of pandemic, reporting on these two clauses are kept in abeyance till 31st March 2021, and the 2021 circular again states that considering the situation of pandemic, these are kept in, two clauses are kept in abeyance till 31st March 2022. So first, to resolve the issue, whether financial year ended 31st March 2022 or the reporting till that period. If you read all the 4 circulars together, since the first circular expressly mentions that the reports issued between 20th August 2018 to 31st March 2019, the subsequent circular also are relating to the date of issuance of circular, date of issuance of tax audit report, and not the financial year. So now taking forward this interpretation, whatever is kept in abeyance till 31st March 2022 is the reports issued till that date and not the financial year. So these are applicable for reporting for assessment year 2022-23 and onwards. There are difficulties in reporting which were already communicated in the year 2018 and subsequently. In clause 44, particulars of expenditure is required to be analyzed, the GST registration perspective, payments made to registered dealer, payments made to unregistered dealer, to composition dealer, and so on. We have represented on 3 grounds. Ground number 1 is, as far as this analysis of expenditure is concerned, between registered and unregistered dealer, etc., is of no consequence for the purpose of income tax assessment. Secondly, the tax audit report, the reason for prescribing it under the Income Tax Act is enabling ascertainment of taxable income. So whether an assessee incurs expenditure which results into payment to registered dealer, unregistered dealer, or composition dealer does not have any bearing on allowability or otherwise of the expenditure. Therefore, this clause should be omitted. And thirdly, consolidated information would be available in annual return of goods and services tax, and due date for issuing that annual return or submission of annual return falls after the due date for the purpose of furnishing tax audit report. And for these reasons, this clause should be omitted. If it is not possible or thought has not been provided, at least to be kept in abeyance till 31st March 2023. Clause 30C is soliciting opinion about impermissible avoidance transactions. In this clause, if you compare it with all other clauses of tax audit report, it's not particulars, it is the opinion of a chartered accountant is sought whether there is any impermissible avoidance transaction. But all other clauses are asking about the particulars. And therefore, this clause does not find place in the scheme of tax audit report. Secondly, if you refer to Form 3C and 3CB, which are to be issued along with Form 3CD, a chartered accountant certifies the particulars furnished in Form 3CD to be true and correct. About the impermissible avoidance transactions, it may be his view, his opinion. It may not be the fact. That will be proved by the process of assessment. So, opinion cannot be certified as true or correct, and therefore it should not be asked. Opinion can be good, it can be best, it can be acceptable, it can be better opinion, etc. And thirdly, even the income tax department does not consider income tax officer to be competent to classify these transactions as impermissible avoidance transactions, for the simple reason that it is a very intricate job, and as far as assessing officer is concerned, he is expected to escalate his view to the commissioner. The commissioner is expected to offer it to the panel, and therefore the panel decides. So the onerous responsibility which is cast on a panel of commissioner, one cannot restrict it to the chartered accountant, and therefore this clause should be omitted, and if not omitted, in the interim it should be kept in abeyance till 31st March 2023. That is our submission to the Central Board of Direct Taxes. If the submission may be accepted, then we are happy. If it is not accepted, we are thinking of giving one standard wording which can be considered by the chartered accountants for the purpose of reporting under clause 30C and clause 44. I also welcome my colleague in council and Vice Chairman of International Taxation Committee, CA Kotha Srinivas from Bangalore. We are in outreach meeting for tax audit report. So if you want to offer any initial remarks, you can offer.
No,
Otherwise, we are going on with questions and answers. So now, along with me, you will have better answers with the presence of CA Kotha Srinivas.
Thank you very much, sir. There is a question which has been raised by a member that an SSC is an LLP with a turnover of rupees 57 lakhs. There is a loss of 38 lakhs, that is a depreciation loss. Audit is done under an LLP Act. Whether audit under section 44AB is required or not, sir?
As far as audit under section 44AB is concerned, it is linked to the turnover of the assessee. In this case, turnover of the assessee does not exceed 1 crore rupees, and therefore tax audit is not applicable. Again, if you refer to provisions of section 44AD,
Also not.
section 44AD provides for estimated income scheme with turnover up to 2 crore rupees. However, in case of eligible assessee, although the partnership firm is eligible assessee, the limited liability partnership is expressly excluded from applicability of section 44AD. So whether the LLP has sustained loss or profit is not of a consequence for taking decision whether tax audit is applicable or inapplicable. We also have presence of council colleague from Bhopal, CA Abhay Chajed. I welcome Abhay bhai.
Thank you very much.
And he is also Vice Chairman of Taxation Audit Quality Review Board, and having reviewed so many tax audit reports, now better quality of responses can flow.
Thank you.
You can ask them also. Whatever. We can supplement.
When says transcript required, will supplement.
Okay. I will answer you. You supplement.
Better.
There is one question raised by a member, sir, that an Act provides that an SSC that opt for 44AD must follow it for at least 5 years. The question raised by the member is that if an SSC opt for section 44AD and in the very next year his turnover crosses 10 crore, will he require to show 8% profit, or he may switch over to 44AB as tax audit become compulsory for him, sir?
If you refer to section 44AD, after having opted for section 44AD, it is necessary for him to continue that benefit for subsequent 5 assessment years. If for subsequent 5 assessment years, he otherwise complies with the provisions of section 44AD. Now, section 44AD to start with is applicable to an assessee having business turnover not exceeding rupees 2 crore. So, where business turnover of an assessee exceeds 2 crore rupees, in that case, he is not eligible to claim estimated income scheme under section 44AD. So, where his turnover has exceeded 10 crore rupees, by offering 8% of income, he has to maintain books of account, subject those books of account to tax audit, and based on the audited financial statements, he can draw income statement and report the income accordingly. That income may be 8%, maybe more than 8%, maybe less than that. Whatever is the income would be acceptable in law.
So whether the tax audit is required in case turnover from shares trading is 9.5 crores. Share trading only, sir.
Yes, as far as share trading turnover is concerned, it has exceeded 1 crore, which is the limit for the purpose of tax audit. So if it has become 9.5 crore, since the turnover limit has been breached, the tax audit would be applicable. However, under clause A of section 44AB, there is a concession that if your turnover is up to 10 crore rupees and if your out of total receipts, not more than 5% are in otherwise than banking channels, or out of total payments, not exceeding 5% are through otherwise than banking channels. Then there is escapement from tax audit. So if he has done only share trading, possibly the transaction of purchase of share as well as sale of shares are through banking channels, and he may qualify for this particular exemption. Of course, it is not only the expenditure on sale and purchase. If there are any other incidental expenses, all those expenses will have to be considered for the purpose of ascertaining whether there is breach of limit of 5% or not. But primarily, from the given information, it appears that with 9.5 crore turnover, everything must be in banking through banking channels. So tax audit would not be applicable.
Thank you, sir. Next question is relating to not for tax audit, but this is amendment in partnership, sir. Partnership firms opting for presumptive taxation under section 44AD. Is it necessary to amend the partnership deed for non-payment of interest on capital and remuneration to partners for the years, as the same is not allowed as deduction?
As far as allowability of interest is concerned, the decision of allowability of interest or remuneration is not based on whether you are opting for estimated income scheme or not. If the partners so decide, they can pay remuneration and interest to the partners. If the partners so decide, they may opt not to pay any interest or any remuneration to the partners. Now, under estimated income scheme, if the partnership is opting, the income of 8% is concerned as if the remuneration or interest has been paid if the deed so provides, and in turn, again on the amount of interest and remuneration, the partners will have to pay tax. They have to include it in their taxable income. So if the partnership plans that in a particular year they want to go into estimated income scheme and they so decide not to pay interest or remuneration, they can amend the partnership deed. However, for the purpose of this partnership deed to be effective, one will have to appreciate that it has to be executed with a prospective effect. So supposing if you are considering this particular withdrawal of remuneration and interest for the financial year 2021-22, the clause should have been amended on or before 1st April 2022. If it is now amended and it says that for earlier period this interest and remuneration would not be available, it would be difficult for them to justify, because on 31st of March, interest and remuneration in terms of partnership deed has already accrued to them. So this decision is always taken ahead of the thing. Of course, after 1st April 2021, if they decide on 1st July 2021, let us not pay. Maybe for first 3 months, there would be eligibility for interest and remuneration, and thereafter it will cease to operate.
Thank you very much, sir. There is a question raised by a member that earlier there were some requirements relating to cash transactions subject to threshold limits for such cash transactions per annum for any company client to be eligible for tax audits. Whether these limits have been revised. And related question, one more, sir. In these case, cash transactions beyond prescribed limit, what is the procedure to be adopted? Should the corporate client provide all cash transactions for complete audit, or it is sufficient to name only random sampling techniques for such verifications? Please advise, sir.
Yeah, I am not able to fully comprehend the facts of the case, but as I understand that as far as company clients are concerned, there is no cash limit for the purpose of whether there should be audit or there should not be audit. Under Companies Act, even if there is no turnover, still there is mandatory audit under Companies Act 2013. Now coming to taxation, tax audit is applicable to companies if the turnover exceeds 1 crore rupees. If the turnover is up to 10 crore rupees, and if the company wants to opt out of the provisions of tax audit, then under clause A of section 44AB, 2 conditions are required to be satisfied, that out of aggregate receipts, not more than 5% can be beyond banking channels, the receipts, and out of aggregate payments, not more than 5% can be beyond banking channels. If these 2 conditions are satisfied by the company, then in that case, if the turnover is up to 10 crore rupees, company need not subject its accounts to income tax audit. However, if the turnover crosses 10 crore rupees, then even if entire turnover is through banking channels, maybe income, maybe expenses, still the company is subject to tax audit under section 44AB.
Now the person is saying he had a case. Person is having two business. In one business he is having turnover 95 lakhs and other business 75 lakhs. Whether the tax audit is applicable, sir? Two different businesses are there and profit from both businesses is less than 6% and transactions are in cash.
As far as applicability of tax audit is concerned, there are certain criteria. As far as turnover criteria is concerned, the turnover, if it exceeds 1 crore rupees, tax audit is applicable. In case of this turnover limit, it applies per assessee and not per business. So if one assessee is doing more than one business, turnover of all businesses is required to be aggregated. So here the turnover has exceeded 1 crore rupees, therefore the tax audit would be applicable. Secondly, if you refer to section 44 AD, section 44 AD is on estimated income scheme, wherein if the turnover is up to 2 crore rupees, you can offer 8% or 6% of receipts as a minimum income or more than that. And in that case, the assessee is spared from maintaining books of account and for getting the accounts audited. Now in this case, his turnover is up to say 1 crore 50 lakh rupees. So if he reports turnover as per estimated income scheme, and in his case it would be minimum 8% because he has notified that all receipts or major receipts are in cash. So even if the receipts are in cash, still he can opt for estimated income scheme and report the income as per minimum which is prescribed under section 44 AD. If he does not report the income accordingly, then even under those sections the tax audit would be applicable.
Sir, this regards the regarding the business of tuition. Business includes vocation and SSC into home tuition, which is not a vocation, not business. Is he covered under section 44 AD? If yes, if he does not show profit 8%, will he has to get tax audit?
For the purpose of tax audit, activities are bifurcated into business and profession. Now this profession is defined in section 44 AA. It talks of profession of technical consultancy, law, medical, chartered accountancy, etc. If the particular tuition is taken by a person who is otherwise covered as a professional, say he is a lawyer, he is a chartered accountant, he is an engineer, in that case that vocation will be classified as a profession and accordingly the limits applicable for profession will have to be considered, that is 50 lakh turnover or gross receipts. And if he is not so qualified and then running tuition classes, in that case it will be considered as a part of business, and if the turnover exceeds 1 crore rupees, he would be liable to conduct tax audit. If the turnover is up to 2 crore, he is offering income minimum as per estimated income scheme. Again, he will be spared from getting his accounts audited under section 44 AB. But if that condition is not met, again he will be liable to get his accounts subject to tax audit.
Thank you, sir. In case an SSE maintains separate books of accounts for transactions other than its business profession, whether the balance sheet, profit and loss account to be attached with the form 3CB, 3CD shall be considered one or relating to business only.
Section 44 AB comes in the caption 4D, and this chapter 4D is applicable only for the purpose of business. So where the assessee is maintaining separate books of account for his personal transactions and separate books of account for business, under section 44 AD, books of account meant for the purpose of business or profession only are covered. Personal books of account are not covered for the purpose of audit, and audit report will be confined to the transactions reported in the books of account of business. Balance sheet which is required to be uploaded along with tax audit report will be that balance sheet which includes only business transactions.
Thank you very much, sir. One member has raised a query that partnership firm has a turnover of around 40 lakhs opting for 44AD, but also for filing tax audit as it says that profit is below 5%. whether remuneration and interest is to be deducted while computing such 5%, and what is the due date, sir? Same as tax audit or is different, sir?
Now, as I understand, the gross turnover is up to 50 lakh rupees, and the income to be reported is below 5% rupees, below 5% of turnover, and therefore the condition for audit under section 44 AD, because the income reported is below minimum amount which is required to be stated, is there. In this case, since the 44 AD provisions are not applicable, one will have to consider the income as appearing in profit and loss account, and whatever remuneration or interest paid will still qualify for the purpose of deduction. So if we assume that the income of the partnership on turnover of say 50 lakh rupees is just 1 lakh rupees, and that 1 lakh rupees has been arrived at after considering deduction for interest and remuneration, the deduction for interest and remuneration is available, and it can report 1 lakh rupees as income when the accounts are subject to tax audit.
Now, the only similar questions are there relating to applicability of section 44 AD.
Yeah, that we have already discussed.
We have already discussed, sir. Applicability of this clause 30C 44, sir, that we have also covered, sir.
Sir, regarding one member has raised a question regarding option trading turnover calculation. So they have asked for option buyers, is it must to add sale value of option along with absolute profit and loss, sir?
What is required to be added? Sale value.
Yes, for option buyer, is it must to add sale value of option along with absolute profit and loss, sir?
No, as far as option trading is concerned, those transactions are settled for difference, and the sale value has got no relevance. Therefore, for option trading, only difference between the sale bid and purchase bid are required to be considered. The only difference from actual turnover is, in this case, the profits and losses are required to be aggregated. So if there are profits of 90 lakh rupees and losses of 80 lakh rupees, then 90 plus 80, 1 crore 70 lakh rupee would be the turnover, and not 20 lakhs or 90 lakhs.
Favorable and unfavorable differences has to be considered for purpose of calculating the turnover, but otherwise the actual profit or loss will be calculated. Correct, sir?
Yes.
For the purpose of turnover only you should take that. Favorable and unfavorable.
So there is one different question relating to that. SSC is a society registered under Cooperative Societies Act 1860, and the turnover is 40 lakhs. Net profit is rupees 5,000. Whether tax audit is required and under which provision it is required, sir?
Tax audit is required under section 44 AB if the turnover of assessee exceeds 1 crore rupees. In case of this cooperative society, the turnover has not exceeded 1 crore rupees. So tax audit is not required under section 44 AB. Now, if you go to section 44 AD, which states that if your reported income is less than below 6% or 8%, you are required to subject your accounts to tax audit. But that provisions of section 44 AD are not applicable to cooperative societies. They are applicable to individual, HF and partnership firms excluding LLP. So here there would not be any breach of provisions of section 44 AD. So even under that provisions for a cooperative society doing business, tax audit is inapplicable.
Thank you very much, sir. Now there are similar questions, sir, regarding that clauses which have already discussed, sir.
30C and 44.
30C, 44. And in case if there are any further queries, we will request members to put their queries at DTC at the time. And the exposure draft is also open for the comments of the members, sir. It's available at the website, sir.
Tomorrow is the...
Yes, so friends, we are having this direct tax committee meeting on 21st of July. So if you have any inputs for the purpose of improving the tax audit guidance note, which is draft of which is available on the website of DTC at
ICA.org.
dtc@ici.org. So you can please go through those those draft of tax audit report. We have given one pro forma also, in which you have to make the suggestions, say serial number, clause number, and the existing provision and what you want to suggest along with your reasoning. So we will be very happy. In case, supposing if comma was required to be given in some sentence, it is not there, and you point out, we will certainly like to give it, because this particular guidance note should be of the best quality. As far as the date of release of tax audit guidance note is concerned, after it is approved by the direct tax committee meeting on 21st of July, it will be provided further to the council of the institute. It was already made available for the purpose of public reactions. So maybe number of reactions we have received, and all will be considered. The revised draft will be placed before the council. The council meeting is scheduled on 12th, 13th and 14th August 2022. In the council, suggestions of council members, president, vice president would be considered. They will be incorporated in the guidance note, and thereafter, latest by 14th of August, the guidance note will be issued for your reading and consumption. So if you have any issues to be dealt with in that guidance note, we will be happy to deal with them. As you might be aware that CA Abhay Chajed is Vice Chairman of Tax Audit Quality Review Board, and they have already released a book wherein common errors noticed in tax audit report have been dealt with. What are the errors and what should have been the reporting? So if you refer that publication, you will also know certain pitfalls which might be committed in conducting tax audit. And my friend from Bangalore, CA Kotha Srinivas, has also stated that for the purpose of elucidation, there might be some examples, there should be some issues discussed. So Direct Tax Committee has decided that after we release this guidance note, we can also come out with issues in tax audit wherein these examples and other matter which is required or which will help conducting of tax audit can be elaborated, can be discussed. So maybe this publication of issues will follow the guidance note, and the publication on common errors in tax audit is already released. So with these three set of publication, I am sure the flawless tax audits would emerge for this assessment year as they used to emerge for earlier assessment years.
Correct.
So I thank all of you for joining this. Vice Chairman Direct Taxation Committee, CA Dr. Raj Chawla from Chicago has joined this particular meeting. At Chicago, I believe it would be 2 o'clock at night, but instead of taking rest, he is satisfying his quest for increasing quality of tax audit guidance note.
Just one point. In fact, I may be asking you about the issues which members have been raising about clause 16D. Now, I'm not sure.
Any other income.
Any other income which is not credited to profit and loss account. So, I think that is one point. If you could just clarify, because there are a lot of issues when we have, published this study on compliance on tax audit, on the reporting oddities, the issues which we have observed. So their members have raised this issue that 16D, there is a lot of notices which has come and passed from the department. So what exactly the reporting has to be done, I think that if you could just clarify would really help the members while doing the tax audit.
Yes, we will definitely take call on what is to be reported. What is seen that in case of proprietors, etc., where say certain incomes of interest, rent, etc., or capital gain is directly credited to capital account and not to the profit and loss account, in number of tax audit reports it has been reported.
Correct.
Any figure which is reported in any other income not credited to profit and loss account is getting added to income under section 143(1)(a). However, without asking the assessee, that merely on the basis of tax audit making this addition is incorrect. Because it is possible that certain income the assessee might not have reported in his or credited in profit and loss account, but while compilation of return he might have included that income in his return of income. So in that case, without considering the computation of income, making this addition is incorrect. So to that extent, the program of Central Board of Direct Taxes about assessing prima facie income is incorrect. So tax audit report would not be able to take care of incorrect programming by Central Board of Direct Taxes. But one solution some members have found out, that assuming that supposing your income is 10 lakh rupees and you have earned interest of 50,000 rupees which is directly credited to profit and loss account and reported under any other income 50,000 rupees. So what technology they are adopting, they are saying income 10 lakh rupees, add interest not credited to profit and loss account 50,000 rupees. So 10 lakh 50,000 rupees, less income not related to business 50,000 rupees, and then they are taking it to other sources. In that case, the program is not making additions. So such technology will have to be thought of, and to an extent maybe let us see how we can include it in our guidance note. Presently our Vice Chairman CA Dr. Raj Chawla is at Chicago, so maybe he will come with modern techniques and he will enlighten us how to deal with this particular subject.
One more.
Yeah, just we'll ask because he's at Chicago. So Raj bhai, if you want to offer any comments, you can offer. Thereafter, CA Kotha Srinivas will also talk.
Thank you, Chairman sir. No comment, but I would like to give the vote of thanks after Kota.
But before that, then Kotha has some question.
Just a clarification. So usually in 44 AD, when firms are subject to 44 AD, they have to declare profit more than 8% without considering interest on capital and remuneration. So let us take an example where we have allowed interest on capital and remuneration, and the profit is more than 8%, say 10%. So that can be considered. So
no, if you illustrate with the example of figures.
Yes, sir.
So say 1 crore rupees is turnover.
Yeah, it's
10 lakh rupees is your profit.
Correct. So the 10 lakhs is arrived after allowing interest on capital and remuneration.
Interest on capital is 2 lakh rupees and
remuneration is say 6 lakhs. Yeah,
okay.
8 lakhs. So afterwards the income is 10 lakhs. So that should not be a problem. And in case of partnership partners, this 2 lakhs and 6 lakhs should be subject to income instead of taxation. So that will be added in their respective individual income.
Exactly. So if the partnership firm is having income of 1 crore rupees, they are, as per profit and loss statement,
10 lakhs.
Profit before interest and remuneration is 18 lakhs.
Yeah.
Remuneration 6 lakhs, interest 2 lakhs. So after weeding out, your income is 10 lakh rupees and you are reporting that income.
Yeah.
So it is more than that, it will be accepted. But while discussing with some chartered accountants, they felt that rather than doing this, it would be better if you amend the partnership deed and omit payment of remuneration and interest. In that case, if you report income of say 10 lakh rupees, still it would be acceptable. And the one more advantage is the partners are not required to report any income on account of interest or remuneration. Maybe you can examine view of those chartered accountants.
No, but when once they draw that interest and remuneration,
once they draw, then there is no going back.
That tax is paid by default.
When we discuss with some chartered accountants, they say throughout the year they debit it to drawings account.
Okay.
And amendment is required, of course, in partnership deed. If you don't amend, then that will fall due for payment. Yes.
Sir, Raj Chawla.
Raj Chawla, sir.
Thank you, Chairman sir, and good evening to all and good morning from USA.
Yes.
All the professional colleagues who have gathered here to discuss the very important ongoing event of Direct Tax Committee, which is revision of guidance note on the tax audit. After several changes in the tax law, it is pertinent to update guidance note so that members can refer this and discharge their duty in an effective manner. I would like to take the opportunity to thank CA CV Chitaleji, Chairman Direct Tax Committee, and very hard worker person, because I have seen his working very closely and whose efforts have made the much awaited updation of guidance note a reality, along with enormous efforts of other eminent experts from profession who rationalize offered their support. I would like to extend my heartfelt gratitude to all my friends from Council and panelists for today's seminar. CA Ranjit Kumar Agarwal ji, CA Sanjay Kumar Agarwal ji, CA Abhay Chhajar ji, a very handsome Central Council member of ICI, and CA Kotha Shri Nivas ji, a very learned person, my young colleague in the Central Council, for
Sir, both of
extending.
us are also handsome.
Sir is more younger than all of us.
You have to revise the sentence.
Yes,
No, you
I
also
have
sleep
seen
quality.
Bhutan sir also. He is really his inputs are very from ground only. He knows. Even today morning I was attending his program on this board of study. He was giving the inputs from down the line. So I hope that all the suggestion inputs we have gathered from this webcast and discussion will further help us in reflecting the guidance note. I would like to thank all Direct Tax Committee team for organizing this VCM. On this note, I like to circulate this VCM. In case you have any query or feedback, please feel free to share us at dtc@ici.in, Direct Tax Committee at ici.in. Happy learning. Thank you all.
Thank you, sir.
Thank you.